Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning breakfast, coffee or tea, and let's enjoy today's episode.
Okay, let's unpack this. For a few years there, the dream of owning a second home, a vacation spot, it felt like it was just exploding.
Oh, absolutely. Low rates, work from anywhere. It was a frenzy.
It really seemed like everyone who could possibly afford it was grabbing a little slice of paradise. But, well, if you've been watching the real estate scene lately, you know something's definitely changed.
It's a major shift, yeah. And the data we're diving into today really shows how big that shift is, especially for people actually financing those homes. The report uses second home and vacation home pretty much interchangeably, so we'll stick with that.
Got it. And our source here is pretty interesting. It's an article from Florida Realtors, and they're breaking down a Redfin report.
Right, and that Redfin report uses Home Mortgage Disclosure Act data, HMDA data.
Which gives us a really clear look at mortgage patterns, doesn't it? All the way from 2018 right up through 2024.
Exactly. So our mission, really, in this deep dive is to figure out what this HMDA data is telling us, like who is getting mortgages for vacation homes now, and maybe more importantly, who isn't.
And why? What are the reasons behind this pullback? And what does it signal for the housing market overall, especially in places like Florida?
Because it's not just, lines on a graph. It reflects bigger things.
Yeah.
Economic changes, how people are living.
Lifestyle stuff, yeah. Even maybe environmental worries. Things that are hitting buyer behavior even at the higher end.
Totally. So let's kick off with the main finding from that Redfin report. It's quite a number.
It really jumps out, doesn't it? U.S. homebuyers took out just 86,604 mortgages for second homes in 2024.
And when you put that in context, looking back at the data they have since 2018, that's the lowest level they've recorded, period.
Wow. Lowest since 2018, and it's down 5% just from 2023.
Right, 5% down year over year for 2024. But, and this is key, if you look at the couple of years before that, well, the story gets a bit more complex. The drop was much, much bigger then, wasn't it?
Oh, yeah, much steeper. That 5% drop in 2024, it actually means the rate of decline slowed way down.
Exactly. In 2022, second home mortgages just fell off a cliff down, what was it, 42%?
42%. And then 2023.
Another massive drop, down 40%.
Okay, so the market for financing these homes went from like a near free fall in 22 and 23 to just a gentler decline in 24.
Precisely. And that huge crash followed the big boom, right? 2020, 2021. Remote work, super low mortgage rates.
Made that second home feel suddenly possible for a lot more people.
It surged then, yeah. So the last couple of years have been this really sharp correction. And it's shrunk the slice of the pie that second homes represent in the overall mortgage market.
How much smaller are we talking?
Well, in 2024, mortgages for second homes were just 2.6% of all mortgages issued nationwide.
2.6%? That's tiny.
It's the lowest share on record for this data set, down from 2.8% in 2023 and way, way down from the peak. Remember the 2020 peak?
Yeah, what was that?
5%.
Wow, from 5% down to 2.6%.
Yeah.
So fewer mortgages and a smaller piece of the overall lending puzzle. And the source makes another really interesting point here. Comparing second homes to primary homes, we know 2024 was tough for buying any home, right? Second least affordable year ever. But second homes saw a bigger drop in demand than primary homes.
That's critical.
Yeah.
Mortgages for primary homes, they did dip, but only by about 1.4% year over year.
Compared to 5% for second homes. So the desire, or maybe the ability, to finance those leisure properties is fading faster than for, essential housing.
Makes sense intuitively, doesn't it?
It does. So let's get into the why. Why are people hitting the brakes harder on financing vacation homes? The source lays out some clear reasons.
Yeah, the first one, maybe the most obvious, is just cost. Second homes are, they're more expensive.
Higher price tag to start with.
Right. The median value nationwide in 2024 was nearly $500,000, $495K. Compare that to $385K for primary homes.
Okay, big difference.
And then add to that, back in 2022, they actually increased the loan fees specifically for second homes.
Ugh, a double whammy then. Higher price, and it costs more to borrow for that specific type of property.
Exactly.
Yeah.
And then there's the basic fact that, a primary home is a need. A vacation home, that's a want.
Right. So when things get tight, inflation, high rates, maybe job uncertainty, what's a first big thing you cut?
Non-essential luxuries,
Yeah.
like maybe financing a second property.
And what about the investment angle? Lots of people buy these hoping to rent them out, right? Airbnb, VRBO.
Yeah, that's been a huge driver. But the report notes that the rental market itself has cooled off quite a bit. Asking rents aren't climbing like they were.
Okay.
And maybe more importantly for investors, short-term rental occupancy rates are down. It's harder to keep it booked.
So the potential payoff isn't as juicy or as certain as it looked a couple of years ago, makes the investment case weaker.
Definitely. And then there's the lifestyle piece again. That boom was so tied to remote work flexibility.
But now, lots of companies are calling people back to the office.
Even if it's just hybrid. Yeah. It means less time to actually use that vacation home, which kind of chips away at the whole point for many people.
There's a great quote in the article that pulls this all together. It's from Lindsay Garcia, a Redfin agent.
Oh, yeah? What did she say?
She talks about the ridiculous costs, not just mortgage rates, but insurance, especially in coastal areas or condos, like in Florida. Astronomical, she says.
Insurance is a big one.
Yeah. And she confirms the rental income thing, says it's much less likely you'll make significant Airbnb money now. And interestingly, she points out that even the wealthy cash buyers, they're still around, but they're playing hardball.
How so?
Making lowball offers, asking for sellers to cover closing costs, things like that, using their leverage.
So even for those not worried about rates, there's more caution, other costs, left profit potential. It's all adding up.
Exactly. And speaking of those costs, especially insurance, the source really zooms in on Florida. It says demand for vacation homes is falling fastest there.
Right. It seems like Florida's getting hit by all the national trends, plus some extra state-specific stuff that's really impacting the second home market.
Let's look at those numbers because they're pretty stark. The Redfin report listed the top 5 big U.S. metro areas with the biggest year-over-year drops in second home mortgages for 2024.
And they were all in Florida.
Every single one. Miami was down a massive 32.2%.
Wow, nearly a third.
Orlando down 28.4%. Fort Lauderdale down 28%. West Palm Beach down 23.7%. And Tampa down 20.9%.
That's a really concentrated decline in major Florida markets.
Right.
Not small dips at all.
And the source connects this directly to those unique Florida challenges you mentioned. Soaring housing costs, sure, but amplified by rocketing insurance premiums.
Which we keep hearing about.
Rising HOA fees, higher property taxes, too.
And there's that environmental angle again. The report specifically mentions the increasing frequency and intensity of natural disasters. Hurricanes, flooding.
It's apparently turning some potential buyers off the state altogether, which makes sense, right?
Yeah, why sink hundreds of thousands, maybe millions, into a place where insurance is becoming unaffordable or unavailable and the risk of damage is going up?
Plus, the source suggests all this combined is making people nervous that Florida home values might actually fall, which, kills the investment vibe too.
Definitely erodes that confidence. But there's a really important caveat here the report points out.
Okay.
This data, it's only mortgages. HMDA data tracks loans.
Right. And lots of second homes, especially the pricey ones, are bought with cash.
Exactly. People are doing that more and more to just sidestep the high interest rates.
Okay. So the drop in mortgages doesn't mean demand has vanished entirely. Some of it might just be moving over to cash deals, which this report wouldn't capture.
Precisely. The article actually mentions that cash sales consistently make up almost half of all sales, primary and second homes, combined in the Miami, Fort Lauderdale, West Palm Beach area. That's the MSA, the Metropolitan Statistical Area.
Almost 50% cash. Wow.
Yeah. So while second home mortgages plunged in South Florida, it's very likely some demand is still there, just funded differently, bypassing the banks.
That really changes the perspective. It's not just that fewer people want second homes, it's that financing them is so tough, so cash becomes even more dominant.
It really underscores the cash is king idea in this segment. And here's another little twist. West Palm Beach.
Yeah, it had a big drop, right? Like 23.7%.
It did. A big drop in the number of mortgages year over year. But even with that drop, it still had the highest share of second home mortgages among all the metro they looked at.
Really? What was the share?
5.6%.
Oh.
So proportionally, even though fewer people got mortgages there than the year before, a higher percentage of the mortgages taken out in West Palm were for second homes compared to anywhere else in the analysis.
So it's still relatively popular for financed second homes despite the overall decline. Interesting.
Yeah. The source briefly mentions a couple of other places with high shares, like New Brunswick, New Jersey, and Riverside, California, and a few outliers where second home mortgages actually went up at tiny bit year over year, like Detroit, San Francisco, San Jose.
But the share there is super low, right?
Oh yeah, less than 2%. So really, the big story in this report is definitely Florida's decline.
Okay, so we know mortgage demand is down, especially in Florida, and we've got a handle on the why. Let's shift to the who. Who is still managing to get these mortgages in 2024 based on this HMDA data?
Well, the profile is pretty clear, and it really backs up that idea of exclusivity. Let's start with income.
Right.
Almost 9 out of 10 second-home mortgages, 86.4%, went to what the report calls high-income buyers.
And how do they define high income?
Median household income for that group was $280,000.
$280,000 median just to be in that group getting most of these loans? Wow, that's a high bar.
It really is. And while they dominate, it's worth noting that all income groups, high, middle, which they defined as 96K median, and low, 64K median, took out fewer second-home mortgages in 2024 than in 2023.
So the pullback is across the board, but the financing market is already heavily skewed towards the wealthiest, and they still pulled back a bit too.
Correct. The contraction is widespread, but it's happening within a market already dominated by high earners.
Okay, so primarily high earners getting the financing. What about age? Any surprises there?
Age is actually where things get really interesting. We see a split. Gen X took the biggest slice overall.
Which age brackets are those?
Specifically, the 55 to 64 age group got 30.2% of the mortgages, and the 45 to 54 group got 28.4%.
So roughly that 45 to 65 range is the most active in financing these homes.
That's right. But, like the income groups, did they actually take out fewer mortgages than the year before?
Ah, good question. Did they?
Yes. Both of those Gen X brackets originated fewer second-home mortgages in 2024 than in 2023.
Okay, so following the overall trend.
But here's the twist. Baby boomers were the only generation that actually increased their activity year over year.
Really? Which boomer groups?
The 65 to 74 age group took out 4.5% more mortgages than in 2023, and those 74 and older, they increased by 8.6%.
Whoa, that's fascinating. While almost everyone else is cutting back on financing, older buyers are actually getting more mortgages for vacation homes.
Yeah, it bucks the trend completely. You could speculate why. Maybe accumulated wealth, maybe retirement moves involving selling a bigger primary home.
Downsizing the primary, maybe buying a smaller primary plus a vacation spot?
Could be. Whatever the reason, it's a very distinct pattern in the data.
Definitely stands out. Okay, and finally, the report also looked at race, right?
It did, and the numbers there are pretty stark too. 4 out of 5 second-home mortgages, 79.7%, went to white home buyers in 2024.
4 out of 5. Okay, how did other groups compare?
Well behind. Asian home buyers received 6.4% of these mortgages, Hispanic home buyers 6%, and Black home buyers 2.6%.
And was the trend consistent? Did all groups see a decline in activity, like with income?
Yes, according to the analysis in the source, white, Asian, Hispanic, and Black home buyers all took out fewer second-home mortgages in 2024 compared to 2023. The overall decline hit across the board there, too.
Okay, so let's sort of wrap this up for you, the listener. Why should you care about all these details on second-home mortgages?
Well, it's not just, some niche real estate stat. It's a window into how bigger forces the economy, those environmental issues, especially in Florida, demographic shifts are playing out in real time and impacting buyer choices, even among wealthier groups.
Right, and it really shines a light on how important cash is becoming in this specific part of the market, which means the official mortgage numbers we've been discussing, they only tell part of the story.
A big part, but not the whole picture. And this data clearly shows us who is still able to, or choosing to, finance these properties. It's overwhelmingly high-income buyers.
And reveals that interesting generational split, with only boomers increasing their activity against the tide.
Yeah, that boomer trend is a significant insight into maybe wealth distribution or retirement strategies.
So, to quickly recap our deep dive, demand for second-home mortgages dropped again in 2024, but the rate of decline slowed way down from the huge drops in 22 and 23.
The reasons are layered. Costs are high. Purchase rates, fees, insurance. The rental market's less attractive, work patterns have shifted back somewhat, and Florida faces unique hurdles with insurance and storm risk.
Second homes now make up the smallest share of the total mortgage market since at least 2018. But critically, while financing is down, a lot of the action, especially at the high end, has likely shifted to cash.
Which this data doesn't fully capture, and the buyers getting mortgages. Overwhelmingly high income. And age-wise, Only baby boomers took out more finance loans year over year.
It really paints a picture of a market segment under pressure, but also adapting, with cash playing a bigger role.
Definitely. And it leaves us with a kind of provocative thought, doesn't it?
Yeah.
Given those ongoing, maybe worsening challenges in Florida and the clear rise of cash buyers everywhere, does this data suggest that owning a vacation home is becoming even more exclusive? Like increasingly just for the very wealthy who don't even need financing.
Or is the pullback in mortgages, especially the Florida situation, more of a temporary thing, a reaction to current rates and maybe insurance costs that could eventually stabilize or reverse?
Will the market for finance second homes bounce back when or if conditions change? Or has something fundamental shifted?
Definitely something to keep watching.
Well, that wraps up today's episode of Reality Reports, where real estate meets real life. For more updates, tools, and insights that will help you buy, rent, or invest with confidence, be sure to follow, subscribe, stay connected, stay informed, and stay ready. Until next time.